If human behavior is influenced by patterns and trends that we barely perceive, imagine what happens when advanced technology like AI starts recognizing them better than we do. It's fascinating and maybe a little unnerving. It also opens a world of possibilities for predictive analytics, decision-making at scale, and the future of how we approach investments, especially in an increasingly data-rich environment. This might sound complex, and to be honest, it kind of is. But on the Asia Tech podcast, we aim to unravel these complexities and break them down into digestible insights, helping you stay ahead of the curve. I spoke with Nirav Shah, a founding partner at Versa Investments. Nirav's journey from engineering to quant trading spans decades and combines a deep understanding of finance with advanced technology and data. We discussed how alternative data is shaping investment strategies, the challenges of extracting alpha in crowded markets, and how AI and machine learning are transforming the investment process. Let's welcome Nirav to the show. Before we jump in, let's thank the sponsor of this episode, Dr. Tech. Dr. Tech can help you build your e-commerce store and start selling quickly online and on social media in just a few days. And Dr. Tech stores are gorgeous, modern, and responsive. They are fully customizable and simple to use. Dr. Tech stores have hundreds of included optimizations that will help you sell more online, and a support team that can answer all of your questions. With Dr. Tech, there are no hidden costs, no commissions on sales, no add-ons to buy. Everything is included in one simple subscription. So go to hello.dr.tech/ATP to get a free trial and start building your store. You can find the link in the description below. Also, Dr. Tech is offering a special deal to the listeners of the Asia Tech podcast. After your free trial, you can get your first full month for only $1. To get this deal, simply type ATP into the live chat and they will send you a special promo code. Thanks again to Dr. Tech for sponsoring, and now let's get back to the show. First of all, for people that don't know, what is a CTA?
So CTA is a commodity trading advisor. Essentially, they use quantitative systematic models to trade in various markets globally, primarily in the futures markets.
Yes. And interestingly enough, you were trained up on all of this in Chicago, which is where all of this kind of quantitative trading really started. If you go back, what was the name of that book? I'll remember it during this recording. But there's some very famous books written by, I think his name was Jack Schrader. I can't remember, but they made us read these books when we first started trading, right? And all of this kind of stuff started in Chicago. So a great place to start. What was it about quantitative trading that got you interested, as opposed to just kind of fundamental research based? I'm going to look at the equity research and I'm just going to invest based on that kind of stuff. Because that's kind of what Warren Buffett does, right?
Yes. So I think there are two different styles. They do complement each other and there is no one better versus the other. I think from a systematic perspective, there is various reasons why there are repeatable patterns in the markets. There are opportunities, arbitrage opportunities that repeatedly arise due to dislocations, due to human behavior, due to market events. And it's possible to take advantages of those. And what happens in a systematic way is, one, there's a human behavior discipline to it. Second, using systems, we are able to do it at scale. So if I have a way to figure out an arbitrage opportunity, I can apply it in global equity markets all over the world. We can do it in emerging markets, developed markets. We can also apply those same algorithms across interest rates, bonds, futures market, commodity markets, currencies. So just the scale of being able to apply our algorithms makes it very exciting. And then I think speed, right? As we are technology driven. So just as the markets today have more and more participants, the opportunities, the length of the duration shorten. So, just having those systems makes it possible to do it very fast.
Do you co-locate your stuff?
No, we do. So we work with brokers, large brokers all over the world who do have those systems. We do not co-locate ourselves. Our trading signals today are more from a few days to going out to several months. So we are not a high frequency firm as such. We are more, intuition, hypothesis driven, with holding periods from a few days to weeks and months.
So do you want to get into the nuts and bolts of like how you come up with these algorithms? You want to get into like the research that you've done or the research that the team has done to do this? So You have to understand that I come out of a long trading and a long tech background as well. And at one point, we were running a bunch of quantitative strategies. Same thing: futures, options, currencies. I mean, I was trading in some markets where, like, in one day, we saw FX markets move like 15, 20%. We saw that move the bond markets in a way that was just insane. This is pre 2000s, right? So pre the unifying of the euro market. So we saw bunds move, we saw gilts move, we saw all this stuff move. We had days where, like, those markets just got insanely crazy, but we were high frequency.
Right.
And I'm curious, like, how you differentiate between, do we want to be high frequency, or do we want to be 1 to 2, 3 to 5 day, or 1 to 2 month time frames?
No, that's a great question. So I think what happens is, on the high frequency side, a lot of it is a technology setup which differentiates one player from the other.
For sure.
Right. And the arbitrage opportunities are way smaller. And so that is one. Second is, there's also an issue of scale, right? Because in terms of proprietary capital, typically high frequency firms are able to deploy only relatively smaller amounts of capital. Versus something for Versa, we are more systematic, hypothesis driven. So there is a fundamental intuition behind everything we do. At Verso, we do focus a lot on alternative data, right? So can you look at alternative data sets, and can they provide signals which are not correlated to other things in the markets? And does that sort of give you an edge, right? So from our perspective, using alternative data sets, increasingly using a lot of machine learning AI models, just sort of gives our edge. And it's, at the end of the day, all driven by economic intuition and hypothesis.
What kind of alternative data are you using?
So, we use a wide spectrum of alternative data sets. So be it transcripts based, news sentiment, be it social media sentiment, news article sentiment. It could be data sets related to credit card data. It's a wide spectrum, right? So right from regulatory filings to some of the esoteric data sets related to flows and web traffic, app traffic. So a lot of different data sets.
Yeah, I mean, there's just a lot more information out there today than when I was trading, which is like 15 years ago, right? So I'm no longer an expert on this kind of stuff. Do you guys ever intervene? Do you know what I mean? Like, you have an algorithm, it gives you a signal. Do you ever go like, I don't think we should do that, and then just do nothing, or do it earlier, or do it later? Do you know what I mean?
Yeah, I think over now several decades of doing this, one thing that we are very clear is, it's never a good idea to intervene. So we let the models run. There is
Yep.
constant monitoring, and there is
Yeah.
a very deep process. So where we are monitoring every step of the process, and in case, so the only typically when the investment committee would intervene would be decisions that not necessarily in the day-to-day trading, but more on the process side. So, for example, right before the Russia-Ukraine war, as the as the room sort of the talk started of Russia amassing armies, the investment committee decided to sort of come in and stop trading Russian ruble, and take sort of a decision of not trading anything related to Russia, right? Or there were instances. So when there were actions taken by the Turkish central bank, which were not sort of in line with what would be expected, and
Right.
so an investment committee had decided to not trade Turkish assets at that point in time. So it's decisions like these on the investment process. But on a day-to-day basis, there is constant monitoring by the investment committee, but coming in and intervening on the models is very rare.
Yeah, so very rare. But can you comment on this a little bit more, again, for people that don't understand exactly how these quantitative models work? This idea that the investment community will get together and say, the thing that's happening, and I'm just going to use Russia because you used it as an example, right? The thing that's happening in Russia is outside of the realm of the normal expectations of the model. So it's not like we don't believe that the model up until now has been good or vetted or backtested, and that the machine learning that we've done is great. It's just that we can't anticipate what's going to happen now based on the past, because it's no longer valid for the current situation. Does that make sense? And maybe you want to explain that a little bit more about how some of these algos work, how they get tested, and why you feel so comfortable, like you said, just letting them ride and not intervening except in cases like this.
So that's absolutely true. And let me take a step back and explain, right? So when
Please.
we come up with an algorithm or a forecast model, it's always starts with an economic intuition. Is there a causal relationship between the signal that we have created using a data set and what we are trying to predict? So there's always an economic intuition. That's the starting point. So these are not black box algorithms. Point number one.
There's an idea behind it to begin with, and then you say, does the quantitative data support that intuitive idea that we have? And if it doesn't, we don't do it. Yeah.
Yes.
Sorry, go ahead.
Yes. Right. So that's point number one. Point number two is, when we take that, we then test it over time. So we typically test it over last 35 years of market data that we have. We test it across asset classes. We test it across geographies, right? So typically, depending on what the algorithm is, what the data set is, and what the kind of signals is, there is robustness checks across time and across asset classes, right? And it's only once we are comfortable that there is a statistically significant um, uh, predictive power, we would sort of put that into production. So now what typically happens is, in situations like this, like the war, we understand that that is not something that the models have been trained on. That's not something that the model has is expecting. And we understand that the asset class will no longer behave as expected, right? There will be unusual behavior in the asset prices in the asset class, which is why we sort of take these very rare decisions on the investment process.
Can I ask you this? As more and more people, so again, 15, 20 years ago, there were just fewer people doing quantitative trading. And frankly, even 15 years before that. So when we started doing it, that we felt at some level that the market was getting crowded, right? And how do you ensure is probably a hard word, right? But how do you feel comfortable that the insights that you're having are unique enough, or that you're trading differently enough, or that you're uncorrelated enough to other people's insights and opinions, that you're not doing the same trade that everybody else is doing? Or if you are, that you're doing it earlier, so you get to benefit from the fact that, oh, they've noticed, so the thing's going to go higher or lower in line with our view. Do you know what I mean? Like, how do you ensure that you're early enough, or that you're late enough that you can then sell something that somebody else has already bought and it's already gone up 15 or 20%? Do you know what I mean? How do you ensure your insights are unique?
That is absolutely true. There is a challenge in terms of the market. The regime shifts, the market participants, the markets adapt to what is going on, right? And so one way, so there are many ways in which we sort of do it. So one way is to constantly look at new alternative data sets. So for us, we definitely we define alternative data set as something that is created, but not specifically for the use of finance. And it's the definition is deliberately vague, because we understand that something that is alternative today may become market standard few years later. So let me give an example, right? 5 years ago, when we sort of started incorporating these in our investment process, credit card data was not very widely used, right? And it was easy to sort of use simple statistical forecasts and genuinely make money out of that, right? But that is not the case today. It is very widely used. A lot of market participants use it, to the extent that we do not necessarily consider it to be an alternative data. So that is one. Second is, we have to be more and more creative. So we cannot just use simple forecasts. We have to be more creative on how to use that data set, what to forecast, combine it with other data sets, be aware of the coverage a data set like that would use, and then use it in clever, intuitive ways. So I think that is how the data sets are being used. We just have to be clever and adaptive to it, right? And it's something that keeps changing.
Yeah, it must be constantly changing. Are there like new things you can trade? Ready? And this is a very esoteric question for me that maybe other people who are listening don't know, but like, are new products being created on such a regular basis that, again, there's enough data out there that you can understand what they're going to do, but there's not enough people trading them so that you can have the proper edge that you expect to have? Do you know what I mean?
So what I would say is not two things, 2 points here. One is not necessarily a new product, but there are new signals being created that are helping sort of sharpen the forecasts that we would have for any particular market or an asset. So for example, in one of our cross-sectional products, we have a group of 30 forecast models that are combined to sort of come up with the expected focus on each of the assets, right? And the question, so that keeps adding based on new data sets that we see. So that's point number one. Point number two is, rather than looking at new esoteric data sets, we can use sensible, market intuitive combinations of data that can provide interesting ways to make alpha. So let me give an example. Uh, right, with the current sort of the advance that has happened in the NLP models and with chat GPT, it is very easy to use those LLMs, NLP models, natural language processing models, to process small texts of data, and that's become very easy. So let me give an example, right? So uh, for various companies, there are job descriptions, and it is now possible to sort of run um, NLP models on the job descriptions to see what kind of content, is there any value in the kind of positions that are there. So initially you would look at, okay, number of employees and statistics around jobs, but now you can add it by saying, okay, is there any value in the quality of jobs that are being added to the company, and does that become interesting? So it's just using new tools on an existing data set in a very interesting way, and seeing, is there
Yeah.
any additional insight there that can support or advance my current set of signals. So it's a constant process, and new ways of signals get added to our signal suite, which sort of enhance current products, not necessarily sold separately as a different product.
Can you talk a little bit more about the impact that artificial intelligence is having kind of at scale on this investment process? I mean, even when we were doing it, again, 15, 20 years ago, all of the back testing that we were doing was somehow AI related, right? Because we then had to go and use it and facilitate like what the market was going to look like and predict what was going to happen in the markets, again, just like you, in different geographies and different time zones and different products. But how has the development of like throughput and compute and just precision in the AI models helped you do your investment strategies?
So when we talk about AI, right, we talk about AI as systems that can sort of reflect and even exceed human behavior. In finance, when we talk about AI, what people usually mean is machine learning. And
Yep.
machine learning is a subset of AI where the models are built and trained on large amounts of data. And today what we've sort of seen, one example of that everybody is familiar with is um, chat gpt, which is a natural language processing model that can be used to sort of generate and analyze text. So what has changed, the two things that have changed, right? When we started doing it, and Verser has been using machine learning since inception of the firm 10 years ago. What has changed is, the earlier it used to be used for forecasting and on signal generation, but today we are able to use AI across the investment process. So in addition to forecasting and signal generation, we are using it for portfolio construction, we are using it for risk management, for trading. So just the scope of where these models and tools can be used has increased across the investment process. So that is one. Second thing that has also changed and improved is that the number of tools that has become available has just gone exponential, right? And
Tell me,
that
tell
just makes it, the large number of tool set that's available. We never had it in standard econometrics, the number of tools that are available. So let me give an example, right? Just if I talk about
yeah.
AI and I talk about neural networks, just within neural networks, there are so many different architectures and models that it just makes it interesting. And often what happens is, there are a lot of these models that are not easily being accessed by others. So being able to so not just having those AI models, that itself is a benefit, but also just the sheer number of models available help us make our forecast better. And and it's a toolkit that just keeps expanding. So that's sort of the 2 points, right? And we are able to apply it more across the investment process, and with a rapidly expanding toolkit.
So just the market just keeps changing and the tools that are out there just keep changing. It's got to be super interesting every single day. It never gets boring for sure. How do you stay on top of the markets 24 hours a day? It's got to be almost 6 days a week. Like you can't just have a team in India, do you? Because
No,
then
that's a
unless some guy
wonderful.
is staying up all night, right?
That's
Sorry,
a,
go ahead.
it's a wonderful question. So, Verser is a New York-based firm. So we are headquartered in New York, with
Ah,
offices.
are you SEC regulated?
Yes, we are SEC
Sorry, go
and
ahead.
CFTC regulated,
Go ahead. Yep.
right?
Interesting. Yeah.
So we have two offices, one in New York, one in Mumbai, and they are designed and very strategically designed in a way that it allows us 24-hour coverage. So just between the two offices, we are able to manage global 24-hour coverage, and we do trade global markets, both developed and emerging, right from Japan, Australia, to US and Canada. So literally, and every other market in between. So we literally do have a 24-hour trading schedule.
That's awesome. Yeah, we used to do the same thing. I used to pass the book to a guy in New York who, I'll be honest with you, was always late to work, which made it kind of funny. And actually, you'll like this. I once went on a business trip to New York, right? And then I traded all day and all night. It was just unbelievable, right? Because the guy in New York was going on vacation. So I said, never mind. I'll go to New York. I had to meet everybody. Then I traded my normal thing. And I think I slept like 2 hours a night. Can I ask you this too? Because we had brokers all over the world, do you just leave your orders with them or do you have somebody watching? Do you know what I mean? And then when it gets close kind of thing, then you have somebody call the broker and say, if it gets to this thing. Because I was always worried that if I just left limit orders with the brokers, right, that they're gamifiable, right? That they would be like, oh, okay, we know there's a lot of activity around this level and we can share that information with other people that are prop trading, right? So if we can get this option to go through this level, it can break out all this kind of stuff. Do you leave orders with people or do you just watch them and then when they get close, start executing?
That is great. That's a great question. We are constantly watching. So we do have a team that's dedicated to this.
Yep.
They are watching. And what we do is when we are trading, we trade with multiple brokers.
Yeah.
We trade
Same.
with multiple brokers across multiple algorithms with each broker.
Yeah.
Right.
Yeah.
And
So they don't have any sense of what you're doing, right? I mean, that's part of the reason why you do it. Yes.
Yes. And often, we'll trade the same version of the algorithms with different brokers. So there is a constant monitoring. And then at the end of each day, there is actually a comparison report being generated and analyzed to see, okay, did the comparable algorithms across brokers, did they behave similarly or did they behave differently? Did each algorithm behave as it was supposed to? And then that report gets analyzed daily, but also the investment committee looks at those. We have detailed discussions around those reports on a monthly basis, quarterly basis, and annual basis. So, and it's a constant process.
Yeah, it's really interesting, right? I mean, I think one of the things that a lot of people who don't do what you do don't understand is that you're not just building algorithms for trading, but you're also building big analytics tools to see how the brokers are actually serving you and what the impact is of the order, how they actually work your orders, right? Because I was actually super actively involved, right? Because there's a certain amount of paranoia, I think, on every trading desk. And I just remember going, yeah, I don't like the way this looks, right? We had a little bit, and I'm talking about a tiny bit of discretion, right? Because I agree with you. If you've done all this back testing and you have this algo that you believe is working properly and all other things are equal, you should just do the trades.
Yeah.
Right.
Yes.
And to be fair, my first boss, I was sitting on a treasury, US government bond trading desk. And the first thing he did on day one when he hired you was he gave you a list of, I want to see how many rules there are. And this is like 1994. So it's a long time ago. But he had, let me see here, 13 rules. Okay. And these rules mattered to him, like really mattered to him at scale. The first one is the position is the most important thing, right? It's more important than price. You control your position through price. And this is quantitative, and this is like quantitative trading at its core, right? And get into the position regardless of what the price is, as long as your decision is made on that price and that you're okay with that, right? So you build that into the algo. And the other thing too is you have to know where you're going to get out, both on your loss side and on the upside. Like if I think this is going to go up 10% and I'm happy to take profit there, I'm doing it. And he always talked about having this, what's the right word? This misalignment between, you can't have a 10% stop loss if you have a 10% profit target. It just doesn't make any sense, right? It should be like 2% and 10%. I can't remember what the exact numbers were, but all these things get built in. I'm curious, when you hire somebody, a PhD in mathematics from MIT or from Stanford, right, or from IIT, when you hire them, what are the things that you sit down and tell them at the beginning? Like, here's the overriding philosophy of Versa.
So I think I'm going to just take a step back on the point
Please.
on the transaction cost, right? So we do have a team that, as I mentioned, monitors the trading globally on a daily basis, and they have two objectives. Objective one is constantly reduce transaction cost, right? And they're like laser focused on that. And then second is minimize the slippage between the model portfolios and the executed portfolio, right? So those are the two very clear objectives for a team that's just dedicated on doing that, right? And they just
Talk about slippage, because I think it's important, again, for people that may not understand what slippage means. It seems obvious to you and me, but maybe someone's listening going, what does that mean?
Yeah. So I think what slippage means is when we are coming up with trades and we are coming up with, so just how the way investment process works is every day there is a ton of data coming in. That data gets processed, and there are signals being generated on, what is the expected portfolio or target portfolio comes in. And the difference between the target portfolio and what we have in our accounts today is sort of the orders that go out. Now, it's important, it's critical that the prices at which those orders get executed are as close as to the model, right? So the slippage, ideally, what we constantly try to do is make sure that they exceed the model, right? They're always better than the model. So there's a team that dedicates to make sure that the price at which the signal gets generated and the price at which we actually execute in the market, the slippage, the difference between the two is minimal, and ideally your market price is better than your signal price.
Right. You're making me really miss trading right now. You're making me
It's
very
exciting.
sad.
It's constant excitement.
Well, that's the thing, right? And that's why, like earlier when I was talking about this, when I went to New York for that business trip, like staying up all night and doing it was not drudgery for me. I'm like, I get to do this more, right? Do you know what I mean? It was more fun. It was not less fun for me. And I didn't care about like the sleep because the adrenaline was high enough. Let's get back to this idea about like when you hire new people, what is kind of like the overriding philosophy that you try to teach them when they first come into the company?
So I think when we hire people, the core quality that we look for in them is their ability to work with data, right?
Got it.
I think ability to work. So we have PhDs in astrophysics, PhDs in biology, who just worked on large amounts of data, often data which has very low signal to noise ratio. And so that's the core skill set we look at, along with an ability to just being quants, and we do need the ability to code because everything is done programmatically. So those are the core skills. So we don't. I think the first philosophy that we tell people is that when you're coming in the when you're working in the field of say AI and machine learning, and typically when you're working with machine learning models in fields other than finance, the variable that you're trying to predict usually doesn't change. So what I mean is, if you have a picture of a cat and the model is trying to predict the cat, that picture doesn't change. A cat is a cat, right? But in finance, it's not so straightforward. Right? There's a lot of subjectivity involved. If S&P is up 2%, it could be because there is a reason for it, or it could just be variance. Right. So there is a lot of noise in the data set, right? And I think one of the first thing that we always tell our researchers is to be aware of that low signal to noise ratio, both in what we are trying to predict and also in the variables that are the predictors or what we are trying to constrain, right? There's just a lot of noise in that, and it's important that they sort of handle that and they are aware of that. And we do enough scientific, statistical, hypothesis driven testing to manage that.
You must constantly be doing market research, data research, right? And just like finance research. How often do you think you come up with like a new model where the team thinks, oh, this is really great. We need to implement this. And like, what does it take to get to a point where you're willing to go out and say, like, how much testing do you have to do? How much time does it normally take? I know there's no fixed answer, but you know what I mean?
Yeah.
Where somebody or a team of people is doing research and they're like, you know, you have to look at this thing because this is going to change the way we trade. Here's the new thing. Like, when does it get implemented, if you know what I mean?
So I think, typically there is a lot of, so the most of the people in the firm are focused on the research side, on new signals, on new tools, on new portfolio construction, on various parts of the investment process. And typically, it could easily take 3 to 6 months for a new idea to get added, right? And what we've observed, after years of doing this in experience, right, is that often it's the changes that are there are incremental, and it's and just the combinations of all those incremental changes suddenly is a big impact, right? So rather than one hotshot idea that sort of makes a big impact, especially because we do deal with these institutional portfolios, so we look for a lot of liquidity and scale in what we do. So it's often a combination of large number of incremental improvements that we are constantly doing. That after a year or so, we realize, oh, the product looks, it has so many different improvements across every aspect of it, right from signals to portfolio construction to risk management and trading, that the overall impact is significant.
Got it. How many models are you running concurrently right now?
So, we have different products, and depending on the product, the number of models running concurrently on could be a combination of 30 to 60 models that are actually in production.
Got it. And do you limit the amount of money or the amount of funds that get allocated to any particular model? Again, so you're not like trading against yourself, if you know what I mean?
Yeah. So we have different cross-sectional products. So there is a futures-based cross-sectional product where we trade both developed and emerging markets,
Yeah.
which are extremely liquid, and there is a lot of scale available. On the other side, we have cross-sectional products on single stocks where we trade long and
Interesting.
short single stock products. Those are capacity constrained,
Yep.
coming in from a lot of the different data sets that we are and the signals that we are trading. So in that particular set of products, we do constrain the capacity.
Got it. So what excites you as you move forward, right? And you have all these models operating. You've got, how big is the team you have?
So we are 52 people across New York
Okay,
and
that's not
Mumbai.
small. That's not small. That's a really big team. But like as you continue to grow and you continue to iterate like on the models and on the products and stuff like that, what do you see coming? Do you know what I mean? Like, what do you anticipate coming? Where you're sitting there thinking, like, okay, as a committee, as an investment committee, as a management team, we have to start considering these things. Like, what is coming up that the rest of us don't know about?
So I think just we are at this cusp of AI revolution where it's
Yeah.
coming into every single thing we do, and it's just like
Okay.
that it will impact every step of the investment process, and that is really exciting, right? The ability to, so being in 2024, right, the number of tools that is there constantly increasing, uh, is it's very exciting. Being in 2024, also the number of alternative data sets is just really increased. Even if we compare it to say last few years, the number of data sets available today has just gone up. That does not necessarily mean alpha has gone up. I think we still have to be very creative on how to extract alpha out of these data sets. But right, so the combination of the two, of having the ability of having a lot of compute power, a lot of different AI tools that we can then apply to a lot of different data sets, and to do it globally across all markets, across a large number of asset classes, both say futures and single stocks, uh, FX. It just makes it all very exciting.
Yeah, I'm just sitting here running through. I'll let you go in a bit, but I just think this idea of alternative data sets is so interesting, right? So again, like 20 years ago, there was no mobile data, right? People would not have looked at insurance data that was mobile. You wouldn't have looked at e-commerce data, like all this kind of stuff, like what people buy, how they pay for it. buy now, pay later, like all of these little things that impact how different companies, how different purchases get made, go all the way back to how does it impact the price of Apple or Samsung, right? Or Huawei or whatever the company is. I'm just trying to run through my brain for some of these alternative data sets. It just makes things way more interesting. And you're right. If you can extract a little bit of alpha out of each one of these little data sets in a way that nobody else can, you win. And to be fair, one of the things that I was looking at as well was one of the things my boss said, and it's different in every market, but like if you win 51% of the time, you're winning. Yeah. Like you don't have to win 90% of the time. You just have to win 51% of the time. I'm curious as well about arbitrage, right? We talked about this a little bit before, but you're competing against a bunch of other traders that are trying to extract alpha in a similar way. As if there's an arb there, so many other people are just going to find it. And they may be looking at different data than you. They may actually be trading a different model than you. But if that arb is there, some other people are going to find it. As those arbs close, how much more difficult does it get to then extract that alpha, even using technology and even using AI?
So I'm going to answer in two ways, right? I think one of the things that's sort of underappreciated on the use of alternative data is that it is operationally very, very challenging to sort of use it, right? And as quants, we are used to it. We are used to having systems processing large amounts of data. We're used to having connectivities with different vendors, with having different data sets. We're used to just working with systems and data and processing. And it just, it sort of is an edge for quants to work on with a lot of these data sets. So that's sort of point number one. Point number two is, I think the point that on the arbitrage, and it's very exciting. Right? So I'm going to take an example of a strategy that I'm very closely associated with. It's a merger arbitrage strategy that we've been running, right? And what we've done in a merger arbitrage is we've gone back over the last 25 years and read every single press release and converted it all into a data set, right? So we've gone back last 25 years globally across all mergers around the world and converted everything, all the information that we could find around that into a proprietary data set. And that gets updated every day, even today, right? Now, we've then used that data set to train our machine learning models to come up with things around so it's a very unique data set, and to come up with things around, okay, what is the probability of a deal failing? What is the probability of getting a competing bid? What is the probability of getting, what's the downside risk over here? What's the market environment, right? So now what happens is, you are right that there could be other people doing it, but as quants, we can apply it at scale. So if I compare merger arbitrage with a traditional analyst, a typical analyst can at max track 5 to 7 mergers.
I was going to say 5, yeah, the most, yeah.
As quants, we can apply that across mergers globally. So we get scale. So that's point number one. Yeah. Point number two is we have built these proprietary data sets and trained our models. So for a merger arbitrage, it doesn't matter what the market goes up or down. The deal makes money as long as it closes. So the only risk to the arbitrage is the deal failing. If we can identify, what is the risk here, due to regulatory risk, due to debt involved, due to the premium paid, then you can control the downside. And so that is sort of an edge that we have. And the upside gets sort of multiplied by any competing bid coming in. So whenever there is a bidding war, that's where the upside comes in. So now if you have a competing bid model, and you can identify which deals have a higher chance of getting a competing bid, and then use that in your portfolio construction process and sizing, that's the edge, right? So sort of edge comes in both from scale and from the kind of models we use.
So interesting. Merger arbitrage itself is just like its own little animal. And you often see, again, I sat on an equity trading desk for a long time, right? So as soon as the merger is announced, you see it go right up to the merger trading for the premium price paid. It sits right there, maybe a penny below, just in case, right? So there's a little bit of room. If a competing bid, and you see massive bids there, right? So just in case it comes off a little bit, somebody sells a bit. But again, if you can do this at scale for thousands of companies, you can, in a way, anticipate. So, and again, because you have other data sets, I'm just trying to think as we're speaking, like how has merger arbitrage changed over time? Well, in the old days, you weren't able to then go scrape like social media or media and see like what types of chatter is out there in the market to give us some anticipation that there may even be a merger bid, right?
Yes.
And then you can then anticipate that and participate. And then boom, once it happens, now you're making another risk return decision. Is this going to be the final bid? Is this deal going to close? And statistically, if it is, we're super comfy just sitting here and waiting for this thing to close, right?
Yes.
And you can actually probably make some money on the stock loan and stock borrow for people who think that the trade's not going to close, right? For people that want to short against you. So there's tons of things you can do.
Yeah.
It's
And
just super interesting.
you said it, right? So
Go ahead.
the social media and the news indicator sentiment is something that's an alternative data set that goes into our models. Right?
That's why I
that
mentioned
is exactly now how a traditional alternate data set is now adding value to our predictions on the various deals.
Yeah, I like it. And because you can do this at scale, right? You don't have to have an analyst going, I'm only covering 5 companies. You can have the computer covering 5,000 or 50,000 companies and listening to the chatter around all of them globally, and then make a decision as an investment committee and just go, I know no one's talking about this, but this company's going to get bought out, right? There's going to be an M&A thing here. Sorry, go ahead.
Right. And then when there is an opportunity and when there is actual deal announced, right, that's where then the arbitrage opportunity comes in, because you can, there is a small spread that sort of, as you mentioned, right, the price goes up, but there is a small spread that can be made. But then that spread can be made, that typically closes in a few months, right? So typically a deal would close in 3 to 4 months. So if you can then do it multiple times a year and then add leverage to it, it just makes it very interesting.
I like it a lot. Okay, look, I'm going to let you go. There's way too much to talk about. I hope you enjoyed this conversation as much as I did. I'm feeling like now left out in a way, because these conversations are so much fun. Nirav Shah, founding partner at Versa Investments. Come back on whenever you want. Like whenever something changes or whenever you want to get a message out, come back onto the show. It was awesome having you here. Thank you to you. Thank you to your team. I'd love to have you back on.
Thanks you. Again, man. I would love to be back here. Thank you. I just truly enjoyed our conversation today.